Oil and gas extraction is defined by immense physical momentum. You spend millions moving steel, rock, and earth to force hydrocarbons to the surface. Standard corporate finance operates on a straightforward assumption. If a company manufactures a physical product and puts it on a truck, it safely records revenue. Physical flow equals financial flow. Applying that standard manufacturing logic to oil and gas extraction is a fatal modeling error. This split-screen model shows what actually happens. On the physical layer, 100,000 barrels flow continuously through a pipeline. But on the financial layer, the revenue representing those exact same barrels does not mirror that flow. It gets blocked, diverted, and delayed. The physical molecules move in a straight line, but the legal title, the economic risk, and the actual cash flow fracture into separate, delayed pathways that operate entirely independently. Because of this decoupling, a technical appraisal of a reservoir's physical size tells you almost nothing about its commercial value, unless you map the underlying legal architecture first. In this industry, contracts are not passive legal safeguards filed away after signature. They are living financial control systems that dictate how a project earns and spends cash, from the initial discovery to final abandonment. A single clause, like a strict cost recovery ceiling or a pipeline tariff escalation, immediately alters a project's debt service capacity and changes the sequence of its tax liabilities. To accurately value these assets, we have to trace exactly where physics and finance diverge across the three main stages of the value chain. First, upstream extraction, then midstream transit, and downstream refining. Economic value is created in the physical world, but it is entirely captured, allocated, or lost in the contractual world. We begin upstream, the most capital-intensive segment of the chain. The foundational rule here is that sovereign governments, not the private operating companies, legally own the physical petroleum resources buried in the ground. Under a traditional concession or license model, a contractor secures the right to extract the oil, books the production as their own reserves, and pays taxes and royalties to the state based on what they extract. But under a production sharing contract, the state retains total ownership of the physical reserves. The operating company provides the upfront capital and absorbs the geological risk of exploration. This diagram shows how a PSC mechanically slices that physical production into distinct financial streams to recover capital expenditure. The first block is designated as cost oil, which the contractor uses to pay back their initial investment. Whatever remains becomes profit oil. That profit oil is then subdivided between the state and the operating contractor, dictated by strict predefined percentage splits written into the contract. This creates a critical financial distinction. Gross production is the total physical volume of oil coming out of the wellhead, but net entitlement volume, which combines the cost oil and the contractor's narrow slice of the profit oil, is the only portion the company legally claims. Financial reporting, reserve booking, and revenue recognition must be built strictly on these entitlement volumes. Basing financial models on gross physical production numbers renders them completely meaningless. Upstream operations carry such heavy costs that they rarely belong to a single entity. Multiple parties share the financial risk through joint operating agreements, even though only one party, known as the operator, actually manages the physical extraction. The operator does not act as a bank. To fund the drilling, they issue cash calls, which legally require the non-operating partners to forward fund their specific share of the operational budgets. These funding obligations create strict, immediate working capital demands. Partners must supply cash up front, often months before any oil is physically lifted and sold. If a partner defaults on a cash call, or if the operator incurs unapproved capital overruns, the remaining partners are forced to cover the shortfall to keep the project functioning. A project with exceptional physical reservoir characteristics and high flow rates can still trigger a corporate liquidity crisis if the joint venture funding mechanics fail. Moving midstream, we encounter complex logistics. A high-producing well is entirely a stranded, worthless asset without physical connectivity to the markets. Natural gas projects demand a rigid contractual interdependency. You need gathering systems, processing agreements, and transmission pipelines perfectly aligned just to move the molecules. These two meters show the contrast between physical pipeline usage and contractual billing requirements.
Your well might only push enough gas to hit 40% of the physical throughput capacity, but your financial obligation meter remains strictly locked at 100%. This happens because of take-or-pay or ship-or-pay clauses. You pay for the reserved capacity whether you use it or not, creating a fixed, recurring cash outflow regardless of the actual physical throughput. This specific mechanism shifts the volume risk of the pipeline entirely off the midstream operator and straight onto the upstream producer. Because these obligations are rigid and span decades, lenders and auditors do not treat them as simple variable transport expenses. Pipeline tariffs must be modeled as strict, debt-like financial commitments. If production drops, these fixed liabilities dictate the project's break-even point and threaten covenant compliance. Finally, we reach downstream refining. The chemical physics of processing raw crude oil into diesel or jet fuel are identical across different facilities, but the financial models are completely separate. In the traditional merchant model, the refinery buys crude oil, takes legal title to the molecules, and bears the heavy inventory risk while the product is being processed. This chart tracks the profit margins generated in the merchant model, which fluctuate wildly based on the crack spread, the price differential between the raw crude input costs and the market price of the refined outputs. Contrast this with the tolling model. Here, the refinery processes third-party feedstock without ever taking legal title to the molecules. As a result, they earn a flat, predictable processing fee entirely immune to commodity price swings. Because title never actually transfers to the tolling refinery, they eliminate inventory valuation risk and bypass complex embedded derivatives accounting. Identifying exactly where and if title transfers is an absolute prerequisite. You cannot accurately present revenue, forecast working capital, or assess credit risk until you know who legally owns the molecules at every step. Zooming out, we can view the entire sequence, connecting a sovereign concession all the way down to a retail market. When you view the chain as a whole, it exposes why basic financial models, the kind that simply multiply expected production volume by a market price, fail in this industry. This waterfall chart shows how a single dollar of final retail revenue is systematically dismantled as it travels backward down the value chain. Starting from a $100 benchmark price, distinct vertical chunks are carved out for downstream processing fees, midstream tariffs, and massive government taxes. The sequence of these deductions matters just as much. By the time that revenue reaches the far left, only a highly diminished fraction of cash remains to cover the upstream operator's initial capital expenditure. Robust scenario testing requires modeling the strict sequential logic of the actual contracts. Account for precise title transfers, correct tax sequences, and specific failure points, like a breached tax stabilization clause or a pipeline underutilization penalty. In oil and gas, legal language is indistinguishable from financial evidence. Seemingly minor operational details, a specific pricing index fallback, a testing procedure for gas impurities, or a slight shift in Incoterm definitions can reallocate millions of dollars in revenue. The finance function cannot afford to simply process invoices after commercial decisions have been finalized. They must proactively scrutinize the underlying agreements before operations begin. To protect cash flow, enforce investment discipline, and survive government audits, finance professionals must read and model the contract long before the first physical molecule leaves the ground.